Hi guys, thanks for tuning in to another episode of Nuggets News. Today we're back with our yearly tax special. So if you haven't caught any of these episodes before, every year we do the latest on the tax rules and any changes. So we've got our expert, Adrian Forza. Welcome back to the channel, mate.
Thanks, Alex. Thanks for having me on again. It's been good.
No
It's
worries,
been an
you've done a great
eventful year.
job. I think you're a crowd favourite. And for those that haven't watched those other videos, I think they're all time stamped. We've covered a lot of those topics if you're new. So we won't rehash everything today. But if you're wondering whether you're a trader or an investor and you've got other questions, maybe about your self-managed super, go back and have a look at those old episodes, which I'll link down below. And all those discussion points should be time stamped. Or we've got heaps of info on our website. Adrian's got stuff on his website. We link to the official documents on the ATO website because it can be complicated, but it can also be easy if you keep track of things and have your printouts and use the right software. But I think one of the big changes in the past 12 months is the world of DeFi.
Yeah.
So is that something you want to start on, or I'll let you sort of take the wheel today, Adrian? But yeah.
Yeah. I mean, look, in comparison to where we were this time last year, DeFi was just picking up. And the good thing is now that a lot of these protocols that we're building are now, I guess, sort of a mainnet, and they're actual products that you can use. They're not just a dream or an idea, and then that piggybacked on that little DeFi bubble we had back in August,
Yeah.
when things went a little bit crazy. I think that's when a lot of people got interested again. Those that probably had held their coins, since the 18 run and then sort of disappeared from the scene. They kept their coins, but they didn't sell, and then a lot of the interest came back around that period. And then up until even yesterday, I'm getting calls from clients that just got in a month ago, and so it's sort of like 2017, 18 all over again, which is great because a lot of clients that I had back in 17, 18 were losing, lost money just because of inexperience. And now they're reaping the rewards because they've held on, they've, done their research, and they've, admittingly, the whole dollar cost averaging strategy, specifically for Bitcoin and Ethereum, worked really well. There's a lot of clients that would put $100. Some were putting $500. Literally a week, you could see all the buys. Just every week, and the 30 grand has turned into $500,000, $1 million now. Like it's crazy, and it's good to finally see some success stories. After the
Yeah.
crypto winter that we had.
Yeah, no, I said that in the group the other day that, well, we're at all-time highs, so just about everyone is in profit. But I said that dollar cost averaging strategy, literally, if you had to put $50 a week of Bitcoin and Ethereum for the last 4 years, you would actually have $1.1 million. So it sounds simple and it sounds too easy. And some people are saying, oh, that's just for those dates. It might not be the same in the future. Sure, but it's pretty simple if you think about that. Most people could afford that $100 a week putting into the two coins, and you'd have $1 million, which is crazy to think about. But anything else on the DeFi? Because I know it's such a topic that people want to know. Can they do this, and can they get yield in their super? How does it work for their tax? What about if you're just
Yeah.
lending versus changing coins? You're all over all that
Yeah,
sort of thing, Adrian?
yeah. So we all know that obviously when we swap one coin for another, that's a taxable event with the ATO. There's obviously discussions now around a lot of these wrap tokens, and it's a bit of a heated topic where, in a simplistic term, wrapped Bitcoin and Bitcoin, it's sort of the same thing. I mean, the price is basically the same. It's just that it's a token that can be used on the Ethereum network for DeFi and other functions. It's probably not going to be a nice thing you want to hear, but I think the ATO is going to go down the lines of saying it probably will be a taxable event. I mean, look, personally, I don't think it should be. It might be similar to, say, if you're melding some jewelry and turning it into another type of jewelry. Is that considered a taxable event when you've done that? Not really. You're just changing, I guess, the form of it. So personally, I don't think it's the right answer. We're not going to know until some of these things go to court, which could be a little while away, because I'd imagine there'd be a huge number of people that are doing these sort of transactions, sitting on big dollars and want to fight the ATO to, I guess, defer the tax or argue that it's not an event, because a lot of these people that are probably sitting on Bitcoin, that invested early on, might have hundreds and hundreds of Bitcoin, and trying to get a yield through lending. And if the ATO is saying, well, it's a taxable event, and there's millions and millions of dollars involved, I'm sure we're going to see a lot of court cases come up specifically for crypto. And I think some of the cases will win. Obviously, some won't. But it's funny. A lot of these crypto investors have got a lot of money behind them now, and I think they will fight to get what the right answer should be.
Yeah, no, it is a very interesting one, isn't it? Almost like even the lending against side of things. There's so many questions that pop up, and then you try and draw the comparisons to, well, would you lend against your gold or silver in the real world? And it's the square peg round hole with the rules as well. I do like the countries that have got a whole new framework, but we haven't got anything like that here just yet. So, what did you want to tackle next, Adrian? What are the sort of top questions you're getting this year?
Yeah, so I mean, look, the DeFi loans is obviously a big one. And that's again a little bit contentious around how you do it, because there's different protocols where so you've got Aave, you can have those interest-bearing tokens, and is that actually an event? Or if you just loan it out on Celsius, you're not really technically selling it, you're just getting a yield from it. As well as if you've got it on a centralized exchange like an FTX or something, and you're getting a yield, then that's not really an event. But if you're earning, I guess, interest on your collateral, because a lot of them got it, Celsius, Binance, Crypto.com, all the DeFi projects on all the different blockchains now. It's not just Ethereum anymore. That's. I think it's going to be hard to debate whether or not that's taxable or not. I think it's just really going to work like, you're receiving interest from the bank, and anything that you're getting is going to have to be declared as income. So if you're getting Bitcoin because you're lending out Bitcoin, then you've got to declare that, And, in terms of record keeping, people ask me, you've got to keep it on, it's getting paid out every day. A lot of the softwares and things like that can handle that now. We're 3-4 years into, sort of mainstream, and there's, a saturated market of all these softwares that can handle that type of thing. Spreadsheets are a thing of the past for crypto reporting. So
that is interesting, because even these days, like we're talking about micro payments or even streaming payments. So as long as the software is there, but that's something that accountants and the ATO wouldn't have ever dealt with before, because technically it's not possible to have like interest payments or income or anything streamed with microtransactions.
Yeah, I mean, one thing that people talk about is, the record keeping is too hard. I think people probably need to look at it on the flip side, where if you are keeping good records on, say, a weekly basis or a monthly basis, where your position is, so it's a lot easier to plan for yourself anyway. One, for tax purposes, and two, to know where all your assets are, because especially when you're using all these different protocols and exchanges, you want to know where all your capital is. I mean, there's been times where we've done reconciliations for clients, and we've said, you've got a KuCoin account, and they've forgotten about it, and they find crypto on there. Yeah. And obviously now in this bull market, it might have been $100 back then, and now it's worth $5,000.
Yeah.
So yeah,
it's always nice. And there are some good websites these days that you can go to that will show like everything that you've done for an Ethereum address, like all your activity and coins or airdrops you didn't even
Hmm.
realize you had, and that type of thing. So
Yep.
the
Yep.
DeFi progress is getting better as well, but also always check those centralized exchanges. Yeah.
Yeah. It's obviously getting a lot more complicated now because it's not just on Ethereum. You've got obviously Binance Smart Chain, Polygon, Solana is creeping up. Um, you know, Cardano, if that ever comes out at some stage. Um, so yeah, it's getting unbelievable. And I mean, there's we've used a lot of projects and a lot of protocols and lending platforms to understand how it all works. And there's a lot of different. There's a lot that are basically copycats, but there's a lot that have a little bit of differences in them. And sometimes there's things like deferral techniques where take like Alchemix, for instance, where you sort of putting the money into the pool and it's automatically paying the loan off for you. But, technically you don't see any sort of on-chain transaction for that, until the loan's sort of paid off. So
Mm.
you're sort of technically earning a yield without realizing it yet, in a way. And that, I guess, comes back to what I talk about every year is we're trying to defer your taxes. And because now is obviously a prime time about looking at your portfolio, and I would imagine that there's a lot of people out there that are sitting on big profits, and it might be best to review and have a look and say, well, there's about 6 weeks to go until the end of the financial year. If I've already made X amount of dollars, I might consider selling. If you are considering cashing some out, is it possible to wait an extra 6 weeks to do that on the 1st of July or the 2nd of July to fall into the following financial year? Because that way, it's going to fall into the next financial year's tax, which, you know, may possibly reduce it because you've already made huge gains this year, but it also will defer the tax to the following year. So something that I do is when I take profits, I usually put it into a stable coin. FTX is my preferred choice because it's a lot easier and lending out in USD. And then when I've got to pay the tax, I'll use part of that and I'll use the interest that I've earned over the year. Because if you sell on the 1st of July, you don't have to pay the tax if you're registered with a tax agent until May 2023, which is basically 2 years away. So think about the amount of money that you could generate lending out stable coins in that 2 year period in comparison to paying it off, within 3-4 months' time.
Yeah.
So that's something I've sort of been telling clients to think about because, some of these stable coins you can get between 10, 20, 30, sometimes it's 100% depending on the day. It's basically free money. You don't want to be keeping it in the bank account earning 0.01%.
No, and in the sort of traditional world, correct me if I'm wrong, but it's a pretty simple, like on the form when you're doing your taxes, it's how much like interest or dividends have you earned that year, and you're typing in a figure. So if you've done good record keeping in crypto, you pretty much get to that point as well, where you're just really declaring a figure as income.
Yeah, that's right.
Yeah.
Yeah, because on your tax return, a lot of people get sort of hesitant because they think that the ATO is going to ask for all of their records. Unless you're going to get heavily audited, they're not going to ask for every single record. But if they think that something is out of the ordinary, then they will. So if you pulled $1 million into your bank account and then on your tax return you've only declared $5,000 of a gain, they probably go, there's something not right here.
Yeah.
But on your return, it's only really a few numbers that you need to declare. And then if you are audited, you need to substantiate how you got to those numbers. And look, I think this year is probably going to be different. I think the ATO knows that a lot of people have made money this year, and I think they'll be gunning for people. I know they've got licenses for like chain analysis and that type of thing, and I've used that software and it's pretty powerful. Some people probably don't think that Binance is providing data, but they're a registered digital currency exchange now. And just the things that I hear that just use a decentralized exchange and they can't see you, but that's probably the worst analogy you could give because it's public information.
Yeah, I mean, it's a little bit like when people say, people used to think they can't see what you're doing with Bitcoin, but these are public open source blockchains. And also, the Australian exchanges have got a tight relationship with the software and the tracking, as well as the other software that Adrian's mentioned. Chain Analysis is more like a private company. You've got that for scanning blockchains. The actual Australian exchanges and the Australian regulators have got a tight relationship there with their record keeping and data sharing and that as well. So, guys, if you're doing the wrong thing on public blockchains, you're probably going to get caught. So, yeah, make sure you have that record keeping up to date.
Yeah, it's pretty powerful what they've got now. And, I'm not saying that, they're going to sift through every single little transaction. It's obviously got to be worth their time. They're not going to come to you and say, what's this $50 transaction over here? They're going to be going for people that they think are targets. Because in terms of the software, you can see that, for example, if you're sending money to, say, the dark web or, child pornography or something like that, they can see the hops. And if it's coming from an exchange in your name and it's going to a wallet and then going to this black market, facility, it's pretty easy to say, well, that's probably your wallet, and then you've engaged in this activity. And something like that, if it's really serious, you probably get a knock on the door from the AFP, because I know they've got data as well. So
you've just got the video demonetized as well there with those few keywords, I reckon, Adrian, but that's okay. No, that's a good point as well. And we've seen plenty of cases where people have been caught, even recently, from being able to track certain stuff. So what's next on the talking points, Adrian?
Probably the big one's obviously staking as well. A lot of people are staking their coins. ADA is obviously a big one at the moment. You've got ETH 2.0, and obviously a lot of these other proof of stake coins that are at mainnet now as well. So the way that obviously works is very similar to interest. So when you're receiving it, you're receiving usually the token, probably 99% of the time. So if you're staking ADA, maybe even Theta is probably another example, you're getting, say, Theta fuel into your wallet every hour or every day, whenever the epoch is and when it pays out.
Yeah.
That, again, is going to be calculated on the value that you receive it at. So, again, record keeping is going to be important. One thing you need to be careful of is, let's say you're earning Cardano at $2 a day, and we get to the end of the financial year, and you've got to declare that as income. The issue with that is, in the following financial year, if the value of that Cardano goes down, you're actually going to just generate a capital loss. It's not what's called on revenue account. So it can actually work against you when the price does fall, because you're only generating a capital loss, but you have to pay the tax for the coins that you generated in the prior year. And that's really important. So what I've been saying to clients, it's all about your risk your risk appetite, but just being aware that, hey, regardless of what you do, there's going to be some sort of tax to pay on that, on those profits. So sometimes I say to clients, look, as part of staking or interest rewards, sometimes it's a good idea to at least take some money out, either in AUD or into a stable coin, like I was talking about before, to cover your tracks later on. Because, we've talked about it in prior videos where, in the 17-18 run, and this is very similar now, where prices are going crazy and people are making money, but we don't know what's around the corner, and the market can change. I mean, that's not my opinion, but anything's possible. And you start paying the tax with a portfolio that you might not
Is a lot smaller.
have.
And there's one exception here as well, isn't there? So you mentioned it before, I think. So some of these protocols have a token that doesn't pay out more tokens. It sort of grows in price as it accrues interest. So how is that different?
Well, okay. Well, say we take like Alchemix, for example. I think they use like the Yearn vaults, and I think it's internally generated where your collateral is then put onto Yearn, and you're essentially paying back the loan that you've taken out. So from a compliance point of view, you don't actually see the payout. It's not like you're getting an on-chain transaction where the interest is hitting your wallet. It's sort of like internally generated, and you only sort of see the event when you, I guess, pay back the loan or it's finally paid back.
I was more referring to like some of the C tokens or A tokens where instead of getting interest, it'll just go up in value. So the token will be worth $1 and then $2 and then $3, rather than getting new tokens at a rate of 3% or whatever it is.
Yeah, so that's probably more of a deferral technique as well. Okay. Yes, correct. Okay. Yeah.
Cool.
Yeah.
That's all right. That's all for me on that one, Adrian.
What else? Yield farming is obviously a huge one now. Obviously started off big time on Ethereum. Now we've got Binance, Solana, Polygon. This is another contentious one, and again, it's going to all depend on how the HO responds. I think when you think about it, you've just got to think that the HO is going to give you the worst outcome, and that's probably the safest route to take, unless until it goes to court and all that type of thing, and there's actually a judgment. So there's, I guess, two ways to look at this, and the first way would be when you're depositing your collateral into a smart contract. Yeah. So let's say you've got a synthetics and an Ethereum, and it's both 50-50 share each, and you're putting that into the Ethereum synthetics pool, say on Uniswap. Mm-hmm. Essentially, what you're doing is you're just providing liquidity for other traders to buy and sell. And as part of that, you're obviously rewarded fees, and internally you're generated obviously a liquidity pool token, which represents your share within the pool. Now, a lot of the software and a lot of talk has been that when you provide the liquidity into this pool, that's actually a sale, and you're basically selling your synthetics and your Ethereum, and you're receiving this liquidity pool token. And then when you sell the liquidity pool token, then you either make a sale or a gain as well. That's probably, like I was saying, the safer route that the ATO would be taking. I don't know if I agree with that because you're not essentially selling your tokens, you're just actually providing it to the network as security. And I understand as liquidity. And I understand that obviously when you pull that out, there is going to be some impermanent loss that you need to account for, but you're still sort of receiving your original tokens that you've just provided in as liquidity.
Yeah, I would have viewed it as putting your coins, or like putting your shares into an order book. It's almost just putting them in to add that liquidity. But if that's a taxable event, then if you got to pay whatever it is, whatever tax rate when you put it in, and then again when you put it out, it negates the purpose for the most part of trying to earn some interest on those tokens.
Look, it's going to create problems where people have been holding their Bitcoin, or we'll call it Ethereum, or their tokens for a long period of time, because that will, one, constitute a sale, and it will also reset their cost date for capital gains purposes, because they might have been holding for call it 11 months, and they're a month away from this 12-month discount. They've put it in this liquidity pool, not knowing that it's a taxable event, and they've got to pay tax on it. And now they've reset their cost date. So I don't think that's the right answer. I think it's really about when you pull the liquidity out. It is a lot more work involved and that type of thing. But I think from a client's perspective, it probably makes sense, and it's obviously a lot better for a tax perspective as well. So that's a big contentious one, because that's on Ethereum, Binance, and all those other blockchains. But I think probably something that's not as contentious is when you receive that liquidity pool, sometimes you can then put it on to the protocol and earn the governance token as well. I think it's pretty clear that those rewards that you're getting as a governance token would be similar to, say, a staking or an interest. So you've got to pay tax on that. And then when you sell it, you've got to work out whether or not there's a gain or loss in comparison to when you've received it. So, yeah.
I would have said that was closer to an airdrop. Like 2017 was hard forks was the flavor of the month, and now it's been a lot of airdrops this year.
Yeah. I think a lot of it comes back to the intention. These airdrops, you weren't, I guess, looking to get it, if that sort of makes sense. Whereas providing liquidity, you're looking to earn a yield. I think it's a little bit different in that scenario. So that's why I think the HO will see it that way, that the only reason that you provided the liquidity was to earn a yield from it, and therefore whatever you're getting will be taxable. Whereas the airdrop, sometimes just because you've used the protocol, let's say the Uniswap, all these people got gifted these Uni tokens, and they didn't. No one knew that was going to really happen, obviously, apart from the devs. So I think it's a little bit different, and that comes back to the intention, what we've talked about in other videos as well.
And with the airdrops, is that just how do people record that, depending on if they're a trader or an investor?
Yeah, look, I think from the HO's website, they say that's income. I don't know if that's the right answer, because sometimes you get given airdrops that you didn't want. So, there was, like those kick tokens that were a couple of years ago. Everyone got a kick token.
I mean, I think it's got to be a bit of common sense, because I think at one stage they were saying that every hard fork is the same thing. But then, there was over 100 hard forks of Bitcoin if you actually go and look at the list, and most people wouldn't even have a clue about 95 of those. So I think it's got to be a little bit of common sense.
Yeah, well, 100%, because you might not have even have wanted that, and you shouldn't have to pay tax on something that was just gifted to you that you didn't really ask for. I don't think that's the right answer. Yeah.
No, it's almost like someone putting a gift card in your mailbox and saying this is worth $1,000, but if you actually tried to sell it anywhere, like, no one is going to pay anywhere near $1,000 for a made up sort of gift card. That's kind of what some of these airy-fairy airdrops and hard forks were. They didn't actually have any value, and so if you actually legitimately didn't want it, you weren't ever planning on trying to make money off it, I think it's just a common sense thing that.
Well, if you think about it from that example, what you just said, what's the difference between someone giving you $1,000 and someone giving you an airdrop worth $1,000? Because you could just take that $1,000 and then buy that token.
Is that like you're saying a gift?
Yeah, because let's say if you gave me $1,000, Alex, that's just a private transaction between two friends, and I can then use that $1,000 to buy that token, but I don't have to pay tax on the $1,000 you gave me. But if you airdropped me the $1,000 of tokens, I have to pay tax on that. So it doesn't really make sense from that point of view.
Okay. Plenty to ponder.
There's been a lot of changes. I think crypto tax 2-3 years ago people thought it was difficult. It's obviously changed big time now, because there's obviously the NFT space as well. that had, I guess, maybe if you want to call it a mini bubble back in February or so. And I think I'm a big believer of NFTs now. Probably a year ago, I think it was still new. So, for me, it wasn't on the radar as much. But I think a lot of people are probably uh, seeing that there is a lot of value now with the NFT space, whether it, and I'm not just talking about the art side of things, I'm talking about gaming and real world applications. Uh, and, the hot topic is, do I need to pay tax on NFTs? And I think it's really going to come down to the intention at the end of the day, like everything is.
Mm.
So I know a client who purchased, I think it was 3,000 name base URLs, DNSs. Is that what they are? I think.
ENS, yeah.
ENSs, yeah. And, he was buying all these different name base files or ENSs that really didn't have any relevance from a personal perspective. So he was there to literally flip these these website names. So, in that instance, I'd probably say that there's going to be tax to pay because he was really in the business of trying to make money. If you, let's say you buy nuggetsnews.eth, well, that's probably more of a personal transaction because I don't think anyone else in the world is going to want nuggetsnews.eth.
No, and I mean the thing that I was getting at when I met with them a few years ago, when they were saying every crypto to crypto transaction is going to be taxable, I was trying to explain that in the future when we're going to have smart contracts and like gaming is a classic example. If you go into Decentraland and you walk around and you might click a button or buy a T-shirt or go play a game and it might be a couple of dollars of ETH. Like all that stuff to me is just, it's almost like going to a gaming arcade and getting some tokens and spending them. I just don't see how you can say that every single little thing, every click of a button, once we go to layer 2, all of those things are going to be transactions. I don't know how you can say that every single one of those is taxable because at that point with true utility tokens, it has nothing to do with like investing or trading or finance really. You're using
No.
the system, the protocol for what it was kind of designed to be in its utility.
Yeah. I think with the gaming space, they're going to also have to come out with some sort of guidance in that area because like if you take, some of these gaming projects, a lot of them are going to take ETH and, you might get rewarded in ETH or you might have to pay in ETH. And, at the end of the day, it's really, you're doing it for personal enjoyment. You're not really doing it to make money. I mean, obviously, there's that little bit of incentive there, but that goes back to in-house currency for different games as well. Is that taxable? I know, back in the day, Diablo had like an auction house where people would sell items. Is that taxable? It wasn't really back then. So then you get into this whole area about whether or not it should be or it shouldn't be. But I think at the end of the day, if it's going to be for personal enjoyment, then it should just be ignored.
Yeah. Cool. Let's push on, Adrian. I think we've got a couple more to get through.
What else we got? Yeah, look, I mean, every year I sort of talk about structures. There's a lot of people coming to me now wanting to set up companies, trusts, that type of thing. It all depends on your time frame, your personal situation, your income levels, that type of scenario. So again, just because your friend's got a company or a trust doesn't mean that's suited to you. You've just got to talk to us or another accountant to see if it's actually going to fit your personal profile. The best time was obviously to set it up yesterday or 2-3 years ago when I was saying to people to put them in these structures. Getting ready for the bull market. But it's sort of never a bad time to set something up Obviously, depending on where you are in your life cycle, because, if you're 30 years old, you've still got 30, 40 years to invest, and you can use those structures moving forward, even if it's not just crypto, it could be other assets. And, there's a lot of people now who have gotten into crypto, they've started to understand the financial markets and how it all works, and then they start veering off to other avenues.
Yeah,
So,
absolutely. Cool. Well, any final thoughts of people at home, mate? I will remind everyone that Adrian looks after plenty of our followers and our members. So there's the link down below. You guys get a discount, and members, you guys get a bigger discount, like always. We love all the work you do, and thanks for answering everyone's questions in the group, Adrian, that are non-stop. But I know it's busy
No
at this
problem.
time of year. So any final thoughts for people?
Yeah, I think it's just, I probably just want to say that, make sure, don't get complacent about the marketplace, especially if you've only got it into crypto in the last 6 months or so. You probably want to talk to those people that were back in the last bull market, even better, the bull market before, if you can, to actually listen to what they're saying in terms of what happened last time. Because there is a lot of speculation at the moment. There's a lot of, I'm a genius talk. And I think we even spoke in January, February about that. And, we did have a dip back then. And it's just, being careful. Tax is one thing, but remember, taking profit is another. And you don't want to be, I guess, taking profit in a loss position just because you wanted to hold on for tax reasons. Because at the end of the day, if you're making money, you pay the tax, you've still got cash in your pocket, you're not going backwards. So just, think about it from that perspective. It's obviously never a bad time to take profit. You want to put something, get it in the middle somewhere, and, be happy as well.
If you've only been in the market for whatever 6 months, you've only seen it go straight up, and you haven't had any of these tax problems that people had in the past years and whatnot. So good advice. So thanks for joining us, Adrian. We'll have to do it again sometime.
Beautiful. Thanks, Alex.
Cheers, guys.